Hi everyone. Hi. Welcome back. Welcome back to VCTV, which is the Venture Capital TV. We have more speakers joining as I speak. Hey, welcome.
Hello.
Hi, hello, hi, Nidia. Hi, Vijay. Great to have you on VCTV. Hi, hello. Welcome to VCTV, which is the Venture Capital TV, and it's from LATOKEN. I'm happy that we have a full house, almost nearly a full house today on a Monday. Glad that all of you could make it today on time from your busy schedules, obviously making time out. So VCTV, the Venture Capital TV, is a platform where we connect investors like yourself with startups who are looking for funding, are looking for that connection, right? So today we're going to talk about early stage venture and seed investments. So all of you are very much experienced in that particular space. So we're going to talk about more details what it takes to get that early stage funding and the seed funding. So before I start asking questions, I would love to know more about our speakers who just joined us for the very first time on our panel. I'm going to start with Alexander from Germany. Hi, Alexander. We would like to welcome you on CCTV and our viewers and other speakers would like to know a bit about you and your background. Thank you.
Yes, thank you, Sunny. I'm very happy to be here for the first time. My name is Alexander. I'm the managing director of Seed and Speed Ventures. And as you can tell from our name, we invest mainly in seed rounds and software companies in Europe, mainly B2B, but also B2C. I'm myself, before Seed and Speed, co-founded two venture capital firms, the German Startups Group and Westech Ventures, also active in B2B, SaaS, mostly software investments. So the topic of investing in early stage and in very early stage, so pre-seed seed accompanies me for 10 years now, and I'm glad to share my experience today.
Fantastic. Thank you so much. Next, I have Akram. Hi, Akram. Welcome to VCTV. Thanks for joining us today. Please help our audience a little bit of background and intro about yourself.
Yeah, sure. I'm Akram Liusi. I'm the founder and CEO of Instaval. I used to be an investment and finance professional. Now I'm a startup founder. Instaval is inherently an enabler. So we basically help the dots connect between the entrepreneurs and the investors digitally and seamlessly. Instaval is an digital investment readiness platform made to promote equity investments in startups and scale-ups. We are based out of Dubai. The remit is obviously global, but we are taking it. I'm happy here to share my experience. Being an ex-investor in the corporate world, an entrepreneur myself, and at the same time an enabler. So happy to be here. Thank you.
Thank you, Akram. Just a little bit of word of caution. Your connection is a bit unsteady. We're losing you in the middle. Thank you, and welcome back. Welcome to VCTV.
Okay.
So next we have, for the first time on my panel, Nadia from Dubai. Hi, Nadia. Welcome. How are you today?
Hi, good. Thank you very much. Thanks, Sunny, for having me join you. My name's Nadia. I am based in Dubai, South African, born Italian. My expertise, a little bit similar to Alex, line B2B SaaS solutions. I did that for 10 years, so focusing on building commercial teams. And I am a general partner and founder of Seed South Capital, which is a seed stage fund in South Africa, where we focus on bridging the funding gap for later stage investors. And we focus primarily on 20% authentic African stories and then 80% very much technology-based startups. I'm the Chief Experience Officer for Women in Tech, so very passionate about female founders and women in technology. For the nonprofit, I focus on land and expand and also go-to-market strategy. And then I'm a mother of 2. So I always like adding that in there.
Ah, great. Thanks for the introduction, Nadia, and welcome to VCTV. Sorry, I just pronounced you Nadia. It's Nadia.
Oh, don't worry. No worries.
Thank you. Next, I have Vijay. Hi, Vijay. Welcome to VCTV. How are you today?
I'm doing well. Sonia, thank you very much for having me on board. This is my first actual participation here at LATOKEN TV. And I'm really surprised that before me, there were 2 people from Dubai. I'm actually in Dubai myself, but based in Abu Dhabi. So it is a small world connecting on this platform. I'm the current managing director of Techstars Hub 71, based here in Abu Dhabi. And at Techstars, we are a global platform that invests in seed-stage companies, early-stage tech companies. We have a portfolio of over 2,500 companies right now, valued at 33 billion. My focus primarily is bring companies or founders from all over the world to Abu Dhabi, leverage on the ecosystem here, penetrate the MENA region, and we are sector agnostic. So right now we have an accelerator program that's in session, which is from January to April, 10 companies at a time, and we're going to be going to demo day on April the 7th, making sure that I'll invite all of you on this exciting event as well. That said, I've been an entrepreneur for the last 30 years, built several companies in different industries, and happy to be here participating on this event.
Fantastic. Thank you, Vijay, for that intro. Thank you so much. Next, I have on my screen Nicholas from Angel Hub. Hi, Nicholas. Welcome to VCTV.
Hi, Sunny. Thank you for inviting me. Hi, everyone. So myself, I'm a French national. I've been entrepreneur and leading SMEs for 20 years plus in the FMCG/food industry in Europe. And then I happened to go to Hong Kong following my wife. She was relocated there. And I started all over again in the investment into startups in 2015. So for the last 6 years, I've been involved with Angel Hub. Angel Hub is the first fully licensed equity crowdfunding platform in Hong Kong, and we are still the only one. And on that role, I'm in charge of selecting and vetting all the startups, so selecting the deal flow for the platform. On the platform, we have investors, mainly individual investors, angels, and some family offices. So obviously, our sweet spot is the seed investment, early stage startups, and that we propose and offer to the investors. We are sector agnostic. We tend, of course, to look into companies who are willing to expand in Asia, but they can be outside of Asia. And so we have today a portfolio of 8 companies after 1.5 years of activity. And we have almost 1,500 startups who came through Angel Hub in that 1.5 years. So it's quite a lot of companies coming in and trying to apply. Few of them are selected, obviously, but we are also building that community of startups to reinforce the Hong Kong ecosystem, which is 10 years old now and growing very fast.
Awesome, fantastic. We already have Karina, obviously, from Angel Hub, and thank you for joining us as well on VCTV. Vandana, over to you, please. Thank you.
Hi, Sunny. Thanks for having me here once again. So hi, everyone. I'm Vandana Tolani from Gurgaon. I was in Jakarta and Singapore for 15 years in investment banking. I had my own family office fund there. This is my 6th year back in India. I did some investments and then I went back to advisory. Currently, I'm connected with 200 investors globally. We are a global entity because we pick up global deals. We do typically $1 million to $25 million, and we are sector agnostic. And happy to see Nadia. I've been talking about her on my panels. She runs a very great women platform. And thank you, Sunny, for inviting her and me. Thank you so much. Yeah.
Thank you, Vandana, and always a pleasure to have you back on VCTV. Last but not least, Devon. Hi, Devon. Welcome back.
Right. Hi, everyone. Thanks, Sunny, for the introduction. I'm based here in Mumbai, India. I'm a partner at Ankel Ventures, a speed scaling ecosystem modeled on the lines of Y Combinator, the platforms like SOSV, by which we invest and scale in early stage companies with pre-Series A and Series A. Scaling is done through Lumos, an advisory platform focused on the healthcare vertical, by which we provide both technical and business interventions to help companies grow through what is usually a mix of data and clinical validation, market expansion into India and growth, introductions to corporations, and things like that. We also invest at 3A, small sums of money, around 100, 200K, and we'll start investing at Series A sometime after April with check sizes of $1 to $2 million. And again, I handle the healthcare vertical. Our accelerator is run along with HCG, India's biggest oncology chain. So we have a very deep interest in oncology and adjacencies. And then there's, of course, other areas of interest like microbiomes and bariatric surgery and AI/ML layers on digital pathology and things like that. Thanks.
Thank you. Great. So we are all set with introductions of our speakers of the evening today. So before I start asking questions, I just would like to introduce myself. My name is Sunny Mohanty. I'm the regional director of Cryptonews VCTV, and I host VCTV Monday to Friday every day. So yeah. So okay, we're going to talk about early stage and seed investments today. It's a very interesting topic. I was having an offline discussion with some of you before we went live, and very interesting, sort of insights are coming out of it. Let's start with this. Let's just give our audience who are watching us today about the current landscape of seed funding. What investors look from startups and founders. I'm going to start with who do I take? Alexander?
Yes, what do investors? I rather look forward to hearing from my colleagues whether their views on this are the same from Europe to Singapore and all the other places we are from. Pre-seed for us means that usually there's not much to see for me as an investor. You know, I have a team, I hopefully have a product, maybe I have a minimum viable product, maybe I have users, and if I'm really lucky, I have paying users, so customers, but that's not for certain. So I define pre-seed or seed rounds as around, I don't know, 1-2 million in Europe, maybe 3. And I have to say the most important thing for us is the team, not because it's easy to say, but because during the course of the investment, when we invest and the next couple of years, usually the business model, the product and the services change a lot. And the team needs to firstly to be prepared to recognize when the system needs to be changed, and being able and willing to do it. So the team is what we rely on, and that means, of course, the rest has to fit. You know, the business model, the market, the technology. We all need to like this, but the single point which can break or not break and make it happen is the team. And so we try to invest in teams which are diverse, which are more than one. So a team is like 2 or more. And ideally, we have the time to get to know the team well.
Right. It's all about the team for Alexander. Okay, great. Thank you so much for sharing. Yeah, sure. Why not? We're going to drill down a bit more into details after this opening sort of question.
And maybe the last remark for this, that's also, I can maybe, because there are founders listening to us, that means also that in the pitch deck, this needs to have its place and explanation. And I often see pitch decks where the Thomas and Anna are founding a company, which does not really help. So you need to show in the pitch deck why you are the right people for this. That's it. Thank you.
It's okay. Thank you. Thank you. Next, I have Vijay. Vijay, you're on mute.
Thank you very much, Sonny. Look, I guess the question is probably, will be answered quite similarly from everyone from all over the world. I don't think there's any dispute in terms of what early stage companies that we look for, such as the team, the product market fit, the early evidence of traction, and also the sizable market that's been addressed, where there's potential to grow into that. But for me, I'd like to just add one more dimension to all this, is for early stage investing, is how much could I add value to the founders? If I feel that while the prospect might be interesting and potentially could be a unicorn, if I can add value to the business beyond the equity that I put in, then I will probably not be the right match or the right fit for these founders. So I tend to look at things that I could potentially leverage on my network, my experience, my domain knowledge expertise, so that I'm bringing more than just the $120,000 that we typically invest in the companies, but whether I can really make a difference. Because I think, given that a lot of founders at this stage could be a two-man team, don't have a lot of resources to do multitasking on so many fronts. But if I can help them with maybe assigning 3 or 4 mentors to them, perhaps make a few introductions that can really change the trajectory of how they grow the business, then I think that is fundamentally a huge advantage for them. So in addition to what I think Alexander was alluding to with the team, the quality, the caliber, the experience, do they really understand? And I think this is really crucial, the problem statement that they're trying to address by way of the solution. If they kind of clearly define what the problem statement is, then they will generally stumble in terms of delivering the product market fit that they think that they're addressing. So you'd be surprised. I think there are a lot of brilliant entrepreneurs out there with great ideas, but they still struggle to clearly articulate what is the problem statement that they're trying to address.
Right.
And that makes it really difficult to perhaps onboard customers, to onboard future investors, because it's not so convincing as yet. So those will be the additional points I'd like to throw in as to what we tend to look for in pursuit of investing in early stage companies.
Sure. Thank you for sharing those points, Vijay. Next I have, Nadia.
Thanks, Sonny. Yeah, 2 very excellent points based on looking at the team and then what you can add value to as an investor based on domain expertise, network, and leveraging experience. Actually, Vandana reminded me, I left out part of my introduction. I work for, my main job is actually, I'm investor relations for Vitality, which is the UAE's first female-focused accelerator. So we're in this region very much on par with what everybody said in terms of seed between 1 million to 2, but in Africa it's a little different. So, early stage of venture capital funding is intended for companies in the development stage, and development stage is very much pilot testing, market research, and there's no revenue, right? And that's very, very difficult, and nobody really wants to fund that without traction, but how do they prove traction? So, 70% of small businesses rely on personal savings for that initial capital into their startup. So founders actually put in their own money. They raise from the 3 Fs, founders, friends, and fools. But in Africa, it's a little different, because the average salary or the average earnings of somebody in the working class is $1,500. So that initial funding, seed funding, is a little different. And so that's where our fund focuses on actually $50K to $150K in dollars of seed capital, and all we look for is a bit of a post MVP traction. So yeah, in this market it's very much on par, but in Africa a little different.
Ah, got it, got it. Great, great. Yes, Vandana was mentioning that, yeah, you are part of Vitality. Before we were having a discussion as well. Thank you. Next, I'll go for Vandana.
Yeah, thanks, Sunny. So typically, before investing, we look at the background of the founders, what kind of team they have, also what value we could add to them. Not only that, we look at the kind of technology they bring on the table and what is the revenue that they have, and what kind of problem they are trying to solve. So I think these are some of the important factors we look at. We prefer a lot of tech in the startup that comes to us, and it could be fintech, agri-tech, edu-tech, health tech, or food tech, or deep tech. So I think that's what we look into.
Right. Thank you, Vandana. Next, Divan.
Surely, I think pretty much everything has been covered. I just add a couple of points. The definition of seed or pre-A or angel round and all, it melds a lot across different geographies and stages and also. I think, across the world, everything before Series A is early stage. So, usually the progression is, yeah, you start a business and there's an immediate circle of contacts, friends, family, that put in money. In many cases, they don't even know exactly what you do, but they put in money because they trust you as a person, right? That's the first round, and then I define the next round as people that are one level abstracted away from you from a social or professional standpoint. So there are connect of a connect, right? Which could be an institution, could be angel groups, could be a combination of the two. That's generally the pre-A or the seed round, right? What you look for is right what people said. Usually the team is the only thing that stays constant at this point onwards, right? Pricing, go to market, all that undergoes tweaks, undergoes pivots. I think what is important is the team stays constant, both the pedigree of the team and the well-roundedness. So at a minimum, one tech founder and one business founder, right? So situations where there's a business, only one business founder that hires a CTO or CIO, or there's an engineering founder that hires a CMO, those work out less often than with two people with the right business and technical pedigree both being co-founders. So that way, it's a well-rounded company from a startup standpoint. What's also important is how well and how long those people have known each other before starting a company. So ideally, it should date back to campus or some affinity which is beyond just work affinity, from a community or hostel or dorm. The word in India is hostel, but dorm, or some affinity which dates back to a point where they just know each other well as people, right? That helps tide over difficult situations that always crop up in our startups evolution. So that affinity between the two founders is very important. And finally, almost everyone talked about pivots and market changes and all that. I think there's some echo here, but I think the humility to accept change in market direction and to be able to pivot is very important. There are a lot of people who are so stubborn with their idea and their pricing model or their IP or things like that. They just don't see how things are changing, and they refuse to pivot, and that's a recipe for failure. So the team, in addition to being highly qualified and well knitted as one entity, should have the humility to pivot in case of adverse market events.
Perfect.
Yeah.
Thank you so much, Devang. Nicholas, would you like to add something to what others have said here?
Yes, thank you. So I do agree with everything that my fellow speaker already said. So I'm not going to insist on that. Maybe one or 2 points linked to the fact that we are a platform. So we are catering not only for the startups but also for the investors who are joining the platforms. So on my side, when I look into a company, I'm very sensitive to how they are able to articulate and explain indeed their idea and the business model behind. It seems that nowadays, because there is a lot of companies launching and a lot of technology available, people tend to try to solve much more specific and difficult problems, which is on one hand quite great if they can solve it. But on the other end, it can become quite difficult to sell to investors, especially in the space of seed investment, where investor may not be very experienced nor have an expertise in all domains. And so because we are sector agnostic, we must be careful that the team is able to articulate and present well their company. So that may be one. The other one, I think, for the seed companies, I noticed over the years that it's quite important to see as well if the company and the team has been able to convince some other people. So it can be advisors, it can be accelerators, it can be prizes. But those kind of awards or pre-vetting, I would say, by someone else becomes quite interesting for us because obviously the team and the company is young. And now on the investor side for us, we noticed, and I think that's an important point as well, we noticed that in the space of angel investors, you would meet a lot of investors who are not really experienced. And sometimes it can be their first one. I think we have a role to play as VCs or platform in our case in the education somehow of the investors and make them able to choose and to help and support the companies they invest in.
Yeah, great points, Nicholas. Thank you. Last, I come to Akram. Akram, any additional points you would like?
I mean, it's very hard to add. And I may ask you, what's the question again? Because a lot has been said.
So it was the opening question to the session, to the episode today. What's the current landscape of seed funding? What is that current landscape like? And what are investors looking for from startups and founders before doing a seed?
Look. The question is obviously very. It should be contextualized by geography. Alexander hinted at it in its beginning. I mean, 1-2 million in Germany is basically. I mean, it's a very high ticket back here in Dubai. I mean, in seed, I would reckon. But I think it's a no-brainer about the team, because at the end of the day, it's about execution and this, how cohesive and how harmonious is that team to execute, and to the point of divine. I mean, it's very important to kind of acknowledge failure fast. I mean, fail fast and pivot fast in order to kind of jump on the next big thing and be alert to your environment. And this is also where I can't agree more with Nicholas. I mean, as a platform, we come in the middle and we try to kind of educate. I mean, we at Instaval, we try to equip the founders with that investment readiness goodie bag. At least they are kind of investment ready. I mean, in terms of in the language of investors. But that can't solve for a passion for the market or how waking up every day at 5 a.m. to hit to hit it. So these kind of things are qualitative things that investors should kind of nail and dissect in the team's quality. So yeah, I mean that. And on the other side, like Nicholas also said, I mean, there are, investors differ by market. So, and our role is to kind of bring education and tools to kind of cancel the redundancy. And the main things, basically, it's, the market scalability, the product market fit, and the ability to execute and pivot fast. So yeah, that's my thoughts on the question.
Sure. Thank you, Akram. Thank you for sharing those additional points with our viewers as well, other speakers today. Great. So, so next question is, while a founder is trying to raise, be it a seed round or early stage for his company, he still has to run a company, right? So how does he do that? He still has to run a company. He still has to focus his energies about thinking about his staff. Also developing his product. How do they manage this? Like, balance this. Alexander?
It's something I admire, and that's one of the reasons I'm very glad to be in venture capital, to work with founders who manage to do this. And there's a lot, no matter how old you are, you can learn from the successful ones, how they prioritize, and that's, in my opinion, something which you can learn. Some know it by heart already beginning, and I have the feeling what the more seasoned, more experienced founders have in experiences and in ways of managing stress and multiple things to do, the younger ones try to counterbalance with a lot more time they spend in it, more energy they spend in it. And so it seems to be a little bit of connecting different experiences here. So yeah, that would be my 5 cents to this.
Okay, great. Vijay?
Sorry, could you just rephrase the question for me again, please?
So what's your advice to these startups to manage their daily sort of tasks? They have to run a company, besides they have to raise funds, right? They have to feed people, they have to look after them, they look after themselves, develop product, as well as raise funds, raise rounds. So what's your advice to them?
Look, I could take more than this hour to give them a proper advice. But here are a couple of important things that, before I just respond directly, I think it's really important to understand that that wellness and mental health has become a big issue in the forefront of not just this recent pandemic, but I think in the realm of entrepreneurship at large. I've been with several entrepreneurs organizations over the last 25 years, been involved in helping entrepreneurs develop both on the personal level as well as on their professional level. And it is a fact that founders generally are faced with really tough choices between not just in the realm of the business, but with their family and also personally. So mental health and wellness is one of the key issues that I typically bring up on the day-to-day basis with the portfolio companies that I work with. One of the joys of what I do, I consider myself having the best job in the world, is because I enjoy just working with entrepreneurs and helping them, talk through these issues about that. Starting a business is not. It's not a project. It's not a destination. It's a life choice that you made to get involved, and it's a lifestyle choice. You're going to live this blended lifestyle of where you're navigating personal issues as well as business, professional, community, social, all at once. Today it's very hard to have your WeChat or your WhatsApp differentiated from what is business and personal chatter, for that matter. So, but to be really good at what you could do to navigate all this various noise that happens on a minute-to-minute basis is to fundamentally focus on yourself first and foremost, to be in a state of good health, whether it's good sleep, nutrition, good healthy food, exercise, diet, and keeping a sense of positiveness that doesn't create any erosion to your frame of mind. That's really important, to build that shield to make sure that you are personally on a very stable level. The second thing that you need to look at is really you need to make good choices with the people around you. Yeah. So by attracting your co-team members, co-founders, they are the ones who are going to provide the additional expanded positive energy and to build a shield to prevent any challenges you might foresee down the road. The third thing is to understand that there's going to be ups and downs. Business does not grow in a linear straight line curve. It's going to be a whole series of ups and downs as you see on a heart rate machine. And to just be collective calm that this is just the norm, that one should not get too emotionally what do you call disengage, or perhaps remove from the reality that you're building something great, that you have to go through all these roadblocks. So my advice to a lot of the founders is surround yourself with good mentors who you can actually work with on a day-to-day basis. Say, I have an issue, can I talk you through, and try to unpack issues both on the factual basis, but also on the emotional basis, to really understand where you as a person in relation to the business issues you're dealing with. And so that's one, I think, paramount importance is keeping good health, keeping a good circle of team around you, and good mentors to advise you how to further navigate your daily challenges.
Absolutely, especially during current times, it's even more needed. Thank you so much, Vijay. Nadia, coming over to you, you obviously invest into female entrepreneurs or female-led founders. So females during this difficult times have an additional responsibility of home, besides taking care of their business, taking care of the fundraisers and everything. So how do you advise them? What do you advise them to cope with all this extra responsibilities?
Well, two things there, Sunny. For the seed fund in South Africa, it's an investment vehicle. For Vitality, while we are busy building the fund, we are an accelerator focused. But in terms of advice, I don't advise, I get stuck in. So my job is actually to help them raise capital. Right. These are startups that have either gone through our acceleration program as female founders, because Vitality focuses on female founders. In Africa, the fund doesn't focus mainly on female. It's both male and female. But just talking in relation to the MENA region and Vitality being an accelerator, that's what I do. I work with partners such as Vandana and other investors. We have a wide network of angel investors, wide network of family offices, as well as VCs that we are connected to. And it's basically taking our founders that have run through our program, or those, and that's, I joined the company. I had been advising for the company for a year before, but I joined specifically post-COVID. Well, actually around about October last year, because we had an influx of female founders going, please help us. We've got the families, we've got our own jobs, we've got the side hustle that's doing exceptionally well, but we cannot focus on investor relations. So can you help us? So, and that's where I focus in, not exclusive, not a retainer, not anything, but just helping them plug into the investors in the region, and understanding what the investors are looking for, and just trying to make that connection where relevant, because 80% of a founder's time, especially the female founders that we're looking at, have spent their time on investor relations. They can't do that. And the money that you're seeing now, there's $43 million that have been invested in 27 startups in the beginning of Q1. Those aren't female founders, some, but I would argue probably a 2% is. And those have started 6 to 12 months ago. So it's really, really important. I'm not going to lie to you, it's a hard job. But I really, like Vijay, I do enjoy it, because I feel like I'm actually making an impact and being an extended arm for somebody's business. And yeah, so it is a tough job, and that's why I welcome forums like these that promote, female founders, startups, what they're doing and what they're going through.
Thank you so much, Nadia, for sharing those insights. Great help to people who are watching. Next, I'd like to go with Nicholas.
Yeah, thank you. A quick one on our side, but very interestingly, the whole model of Angel Hub is to alleviate the burden of founders when they come to raise some funds. And the idea there, and that's maybe quite different from other platforms that you may find around the planet, Angel Hub is taking care of talking to the investors. So the founders would have to talk once to us, get everything prepped with us. But after that, we deal with the investors, we deal with the structure of the round, we deal with the legal side of it, and we structure the round around the SPV at the end to make sure that everything is simple for the founder. So we are sort of multiplier for founders, and that's the whole idea of a platform.
Okay, cool. Thank you for being brief. Thank you. Vandana.
So I feel that we all are hustlers, and everybody is trying to hustle in their own manner in some form or the other. So I always advise to the startups and entrepreneurs that firstly they should do their exercises in the morning, read the book The Power of the Subconscious Mind, come out of their fears, and be risk takers at some point or the other. Also invest in the making a good pitch deck. Having a good pitch deck and investing in it, many promoters are skeptical to do that. I feel it is very important to have the right kind of pitch deck, a CFO in your company, an advisor in your company, a CTO, a team that complements each other. When you start looking for investors, it's very important to understand their thesis and avoid cold calling to the investors that are doing something different than what you're proposing. Not only that, reach out to the right kind of investment bankers who have the strong relationships with the investors, and they could help you get the funds very easily. So I think this is what I advise everybody here.
Thank you. Devan. Thank you, Vandana.
Thank you.
Yeah, I think a lot has been said. I'll just echo a couple of important points that I strongly agree with, and a couple of other ones. I think really pitch deck is very important, as she said, as Vandana said. I think you still see so many business plans where they write their whole life story in the first 2 slides with no good layout and bullet points. I mean, all that should be in backup slides or in notes. The slides should be crisp, well articulated. 10, 12 slides really can tell the whole story, to an investor. So really spend time and effort. It's not a nice to have. It's a very important thing to have a great slide deck. Regarding lifestyle, again, what I tell people and what quite a few startups follow is that there's few things in life which are sacrosanct. Like if you do have to exercise 30 minutes a day, if dinner is sacrosanct, that you make it in time for evening dinner, even if you're a startup, stick to that. Just today everyone is working remotely because of COVID, but it's always been easier to work remotely today. So you don't have to stay at one location and make a big lifestyle compromises necessarily. You can still have at least a semblance of a balance. It's difficult, of course, it's for a startup, but don't get into the rut that if I'm not working 16 hours a day, I'm doing nothing. It's just not true. I think people that are productive can do well with a 10 odd hour day. So don't go by the volume of time necessarily, but just go by the quality of work produced. There are metrics to gauge how you're progressing, as opposed to that every person 80-hour week and will be successful. Don't go by that approach. Just do smart work, do good work, do productive work, and try and maintain balance. Health is really important.
Yeah.
You can't get burned out in 3 years. It's a longer journey for a startup. So you have to stay, and you need to have hobbies. You need to have friends. I mean, you need to have those things in life which keep people, sane and motivated, right? You can't just say I'm a 3-person startup, 100 hours a week in one garage room, and that's just idolized, and it's glorified beyond the point, actually. So
Yeah, I totally agree, Devang. You're a long way to go. You're just raising your early seed round. So please don't burn out yourself out. Thank you so much.
Correct.
Akram?
Yes, thanks, Tony. Yeah, look, I'm quite biased for this question because this is our kind of bread and butter. So we definitely help startups. I mean, we take off the burden off their shoulders, obviously, as we are a platform. Yeah, we can. I'll take some time to get into I mean, what do we do basically? I mean, if you go to our website, it's very clear and simple. Get funded in 3 steps without breaking the bank. So basically, we are lowering the barrier to access investment banking capabilities to take that strategic CFO role of their shoulders or kind of outsource it. Yeah, this is basically our kind of canned argument to the question. Yeah, the advice is find help. I mean, is my micro. I mean, make or buy. I mean, always buy because it's faster. Make it kind of more problematic unless you are very good at it. So make it. Otherwise, buy it. But I mean, yeah, I very much tend to agree with VJ on the hygiene, and it's super important. I mean, and again, I mean, a small reminder. I mean, we are talking assets valuation here, and the most valuable asset is our time. So if you kind of screw up with that, I mean, you know, that's the base of everything. So we're just building, you know, layers of assets on top of that one. So you know, make great use of that time. And again, if the best advice, if things are not moving, it means that, you know, chances are you are on the wrong model. So and technology is so fast today, so that, you know, I mean, shortcut away out there so that the curve shifts. I mean, there is an opportunity of curve shift. So instead of kind of hustling, you know, if you do 16 hours a day without any I mean, great return, something is wrong, definitely. So founders need to kind of acknowledge this, and it's not about you know, how long you run. It's about how fast and how far. It's not
Yeah.
you know, it's not the time. So yeah, so that's my
Right.
view on that point.
Thank you, Akram, for adding those points to all our speakers. That's great insights coming out from this panel today. So let me shift the focus towards the VCs now. So we spoke about the startups, the founders. Let's talk about the VCs. So what are the challenges the VCs face? What are the challenges for VC who do not have the dry powder? So that's one. And what is the opportunity for those VCs who have the dry powder? So let's just plug this into one question and take one answer. Insights from each of you. Start with Alexander.
Sure. If I understand you correctly, challenges for VCs, yeah, at least here I see that from a founder's perspective, fundraising is always difficult because you have there's always less funding available than one would like to see. However, from a VC's point of view, we have more money than ever available for founders. And that means there is actually, for the very good deals, for the best deals, there's a lot of competition. And that means you need a really clear way of showing. I think Vijay stressed the point to show what can you bring to the table besides money. I mean, connections, know-how, anything else. This is one point. The other one is I see a lot of more Series A and later stage VCs coming down in the stages to the pre-seed and seed stages, which is an obvious choice because they want to get in early. If you are a founder, my advice would be, if you are 150% sure that everything works well, can be a good choice because you have a large investor on board and everything goes well for the Series A. Although in my experience, the large majority of startups develops well, but there are only few who develop really well. So, and if it goes okay or not so good or just good, then you need somebody at your side who can help you. And these are usually angel investors, seed stage VCs, for whom the ticket is important. If we give 500,000 euros for us, it's important because that's our large first ticket. For a large VC, you can write off the money sometimes, and you don't get the support you think you deserve. And it's nobody's fault because the large VC has other priorities. And so I cannot complain about this. I just want to warn founders who listen to this I would rather choose investors or VCs the right size for my face. So in the very early stages, rather join and get some angels on board, some seed VCs, join a program. However, approach larger VCs later in the phases. This would be my 5 cents regarding this topic.
Very, very good points. Thank you, Alexander. Vijay?
Yeah, it's an interesting question. I think if I was thinking of doing a startup today, back to 30 years ago, is dramatically different. I remember my first company back in the early 90s. It was so hard to raise capital. Venture capital was not something accessible. You have to go to a bank, and it's a non-starter when you don't have track record and what have you. But today, the world is dramatically different. I think most cities around the world have a thriving ecosystem that's very supportive of early stage founders. You have government agencies, such as the one that I'm affiliated with, the Hub 71 here in Abu Dhabi, backed by the Sovereign Wealth Fund, supports incentives through subsidy of housing, office space, and of course you got equity back venture or equity-free back ventures as well. So the access to capital today is so easy. I think the key issue is not so much the access to capital today, which is widely available, as alluded by Alex, but I think it's the question for me is more, it's easy to start up, but it's much more difficult to scale up. Right. And this is something that I think we should put a spotlight on, because when you raise your first 100,000 or 250, what happens next? We do see that there is a chasm for a lot of founders to cross before they can actually consider successful when they get to, say, a Series A type companies with revenue traction, that they can then attract the true VCs to invest in the amounts of 1 million to 5 million in Series A. So the ability to scale up draws out a few of the winners from the pack, simply because they're the ones who really understand the true product market fit. They have the tenacity to go through all the difficult hurdles in building up the early stage company. But they're also the ones who actually are very aggressive in terms of doing the research, in terms of which of the markets to go for as their GTM priorities, doing the research, who are the investors they should be talking to at the right stage, investing in relationships along the journey of doing that. And therefore, they have a much more predictable outcome of success than, say, a founder who's approaching this rather haphazardly. So the environment is very friendly, no question about it. There's a lot more dry capital out there that is accessible to a lot of founders, but we do see most of them fail for the reason being poor product market fit being the number one reason. But then the number two reason is really running out of cash, because they're not able to convert their product into a reliable source of revenue that can be self-sustaining, or they run out of cash, simply they don't have enough capital to return to the next fundraising. So I think, to me, the bigger consideration is really the ability to scale at the point where they've proven that they have an MVP, they've proven that they have a product market fit, and this is where VCs are very wary about picking a very select few winners from the rest of the pack.
Thank you so much, Vijay. Very nicely explained. Thank you. Nadia?
I'm going to take a different angle to that question. And it's basically coming from my background and where I see myself in the ecosystem. So I think one of the challenges for venture capital firms, if that was the question, I kind of started listening to everybody and then got lost, is, to be honest, diversity. Diversity in the portfolios, diversity in the decision-making management at the table, diversity in the investment committees. And I say that because, you know, from an outside perspective, more than half the world's not been accounted for in terms of the startups, and there are incredible startups out there. And it's not that the VCs don't want to invest in them, it's just the understanding, the pattern matching cannot happen if the diversity in the decision making, you know, in the management or the investment committee doesn't change or just be added to, you know. So I think that is based on what I see in the region, and also a little bit like in Europe. You know, in Africa it's a little different, but still, you know, females at the decision-making table are few and far between. In America it's less than 8%. But I just think it's exciting. It's an opportunity, but it's also a challenge. You know, how do you diversify your portfolio? How do you diversify your management and that whole transformation process? And I'm very happy to see a lot of people taking it on board, but it is a change in change in thought process, and hopefully happens sooner than later. But that pattern matching can't happen unless VCs diversify their management and their portfolios.
Right. Great points. I just think that I just could go on with this panel, but we just coming to you know, end the show soon. So just quickly, Nicholas. so just repeating the question: the challenges for VCs who do not have the dry powder, and the opportunities for the VCs who have the dry powder. Nicholas, over to you.
Yeah. No, indeed, it's a challenge for a big bunch of investors, and that's what we are trying to bridge with the platform as well, giving access to a deal flow to some investors who, in fact, are not pretty much connected to the right persons to get those good deals. Another point, which is maybe the symmetrical point from what Alexander was saying, it could be interesting for some angels, for instance, to be part of more mature deals, because they would learn a lot about how to invest and how to deal with companies who are a little bit matured, because obviously this is what we all hope will happen to those investors, to be in a company successful and going to Series A, B, C, Ds, and so on. And they must get ready to that, because what we see very often is early stage investors being ejected or screwed by more matured VCs and investors that come on board with their own terms, and the angels are not ready for that. So that's another aspect we try to help.
Okay, great sharing there, Nicholas. Akram?
Yeah, very interesting question. I'll have a quick take on that. So, yeah, it's a very noisy world today. So, I mean, and at the same time, mankind and humanity are at the age of abundance of entrepreneurship, capital, and technology. So it's getting very noisy, and this is the opportunity for players such as Angel Hub, such as ourselves, to kind of bridge the and of course to Vitality, Nadia here, to kind of bridge the gap between the both sides of the table, and the idea is to do, you know, education, curation, and verification, basically to make things so that investors focus on what they do best, is basically excel and you know, as Vijay said, to inject value. It's social and smart capital. And you know, entrepreneurs, you know, do what they do best, is hustle and build value. So I think, you know, there's a lot of mismatch because of this noise. So for example, you know, someone who needs you know, few signals of traction is looking for, you know, go ask a VC that invests in Series A. So they're destroying value here. I mean, and this is it happens all the time. So this is where I think we come in. I mean, more players like ourselves should come into the middle to kind of, you know, correct the signals, so that, you know, it's destroying value. And I guess, I mean, a last recommendation. I mean, this is kind of a vision, is that we need to find a way. I mean, a utility that cancels redundancy out there. I mean, investors don't need to see the same opportunity 10 times and say no. I mean, there must be some kind of a utility out there, in a blockchain utility maybe, that's, and investors don't need to see 20 investors with the same results. So yeah, I think this is just a thought.
I think Akram, we can have another panel just to focus on this topic. Just conscious of the time, we are a little bit way over time, but Devang and Vandana, very quickly, your insights on this.
Yeah, sorry, go ahead, sir.
Vandana, go ahead.
So typically, VCs don't like to spend more than 90 seconds on a deck. So I request the promoters that to make their deck short and crispy, make it more numeric and less texty. Not only that, have a video pitch that solves the problem very fast, and reach out to the right kind of VCs. Study their website thoroughly. Otherwise, they also get spammed by so many mails and repeat mails. So since there's a lot of competition, it's also difficult for the VC to decide what to select and what not to select. And typically, deals do close on relationship basis. So, if you have a strong relationship with the VC, I think the deal would close faster. So I think these are some of the factors that one should consider. And having women-led funds, wherein women are given the opportunity to manage the money, I think that would be a great thing, to have in.
Sure, absolutely agree, Vandana. Thank you, Devang. You're on mute.
I think Vandana said it well. I think others did too. VCs themselves sometimes have to differentiate, right? So it's a two-sided street. Usually, VCs like Sequoia, Axel, or the premier VCs don't have to market themselves much because they're well known across the globe. So there's some self-selection process. The best startups and best deals go to the best VCs first, right? And then other VCs have to compete for good deals, right? There's enough deal flow from both sides, but for good deals, for the best deals, for the premier startups, VCs do have to compete. What we do at Antel is because we have a speed scaling ecosystem, we like to think of ourselves as a true value-added provider of capital. But we just don't put in a check and invest. We also provide advisory and scaling services. So a startup has what the two most key ingredients they need for growing, which is capital and advisory. We provide that together, which is how we differentiate ourselves, and we like to position ourselves to startups. Yes, thanks.
Okay, great. Thank you, Devang. Before we wrap up, I just want to ask one question. You can say yes, no, or just one line because we're just a little bit way off over time. Are you as investors looking for down rounds from companies or startups whose current investors do not have reserves to reinvest during difficult times like this? Alexander, you're on mute.
Not in down rounds, meaning a lesser valuation. However, we look at all the deals we can get our hands on, and there were even some deals where the current investors were at the end of their fund, and so we try to take over. Yes.
Perfect. Thank you, Vijay.
It rarely happens, but I think when that happens, my view is that down rounds are not necessarily a bad thing. I think you have to look at the long-term value of the company. Right. And if due to economic circumstance, like recently in the last 12 months, we've seen a pandemic, a lot of valuations were taking a bit of a backseat. Yes. But having a long-term time frame, 5, 7, 10 years, it's just a number on the paper, right. And that will eventually find its way out of it. If you believe fundamentally the team is good, there's a huge prospect on the addressable market. So I'm not wary of down rounds. I just think it should be evaluated carefully as a good use case or not.
Perfect. Thank you. Nadia?
I share Vijay's sentiment as well as Alex, but for Seed South Capital, no, it's not a focus area at this stage. But it is definitely something to think about for future, and thank you for bringing that up.
Awesome, thank you. Nicholas?
No, we tend to avoid those situations unless we have a clear view on the terms of the previous round, the sentiment of the shareholders, just to make sure we do not enter in a sort of messy situation. So we would tend to avoid.
Right. Akram? Thank you, Nicholas.
Yeah, it's a very difficult question. So if it's a binary, I mean, if a down route versus the extent of the company, yes, for down route, but otherwise, it's very complicated to advise on down route. So, yeah.
So no, thank you. Vandana?
It's complicated to advise such companies, but nevertheless, we are open to look at it. We will look at the background of the team as well as what they are bringing on the table in terms of technology. And there could be something that could be worked out. I mean, it's not a no as in no, but we would like to look at it and then take a call.
Sure, thank you. Devang?
Yeah, I think philosophically, I mean, a short answer is no. Philosophically, it's just trying to being, too opportunistic, unless you're just trying to extend the runway and you're sure things are going to turn around in the next few months. That would be philosophically the reason to do this. But structurally, there are problems, anti-dilution kicks in, and, who has rights and liquidation preferences. And, the previous investors would not be keen to stay on for a longer time if they have a down round, and then there's more distress and duress, frankly, the moment there's a down round for the earlier people. So you end up, taking the burden of proof in some sense and all that. So I think it's very messy, a down round. It should be avoided, I think, and trying to be opportunistic on a down round is something we frown upon.
Right, got it. Thank you, Devang. Let's quickly take some feedback from the first timers today on the show. Vijay, Alexander, Akram, Nicholas. Let's start with Vijay. What's your feedback?
Firstly, once again, thank you, Sonny, for moderating, and LATOKEN TV for inviting me. It's been such a pleasure being here. I think the most fascinating thing for me is the panelists, listening to their views and their contributions. It's been very enriching. The second is, I think the questions are so valid to any founders listening. Whilst a lot of the information might be seemingly familiar, but I think the the reiteration and the it serves as a good refresher.
Thank you.
Yeah.
Thank you. We'd love to have you back on another episode of VCTV. Thank you, Vijay, for sharing your insights.
Thank you.
Alexander?
For me, similar to what Vijay said, and also I'd like to add, I'm very, I was very, the situations founders are in and the ways we as investors or supporters act seem to be the same everywhere on the globe. And what Vandana said about how you start your day to overcome the difficulties, this is something which I will look up for myself and tell my founders, because I think this is like the secret. A good idea is nice, finding a team is nice, but to have the strengths every day to get up and overcome it was an interesting remark. Thank you.
Thank you, Alexander. I'm going to have you back on another episode for sure. Thank you for sharing your insights. Nadia?
Thanks, Sunny. Yes, I mean, for me, I just enjoy learning from a different eclectic group of people, especially from an investor perspective, but also from a platform perspective that facilitates startup and investment, as well as mentors and coaches. I feel like there's a lot of that comes off the panel, and just echoing what Alex said, and it's we all just want the things to work out for the founders. They have it rough enough for themselves. So, whatever we can do as investors, as facilitators, as platforms, as mentors, as coaches, we want to. And I think that comes through a lot in this panel. So thank you for hosting.
Sure. I'd love to have you back. Thank you, Nadia. Nicholas?
Yes, thank you very much. That was my first time and very interesting. I was very happy to exchange ideas with the other panelists. I think obviously we do progress by exchanging ideas and listening to various experiences. And by the way, I hope we can keep that discussion going even after that brilliant panel. I think, yeah, that tends to prove for us that there is really a space to bridge between investors and founders, because each of those populations have their problems, and there must be a way to solve that by bridging it. So nice experience. Thank you.
Awesome. Thank you, Nicholas. Akram?
Yeah, thanks, Sonny, for inviting me and hosting this panel. On the personal level, I'm very happy to meet new faces and old faces as well. Yeah, and I learned, obviously, there's so much energy in learning new things, and basically, yeah, finding out as well that same problems are a bit everywhere. So yeah, thanks for having me in this panel. Thank you.
Awesome. Thank you, Akram. Devang?
Yes, it's not my first time by any stretch. I've come on quite a few shows. I thank you so much again for hosting us. I like the fact that the audience is growing more diverse by both geography, by gender, and by school of thought and things like that. So always something to learn, always something to grow. Thank you, Sami.
Yeah, so sorry, forgot to add Devang and Vandana are our regular speakers. Vandana. Thank you, Devang.
Yeah, so thank you, Sunny, for having me here over and over again. And big thanks to LATOKEN TV. They are connecting people from all over the world, and having such panels where people could exchange thoughts, like-minded people, and these are therapy sessions, and anybody could reach out to us through these sessions, and we are connecting the dots worldwide and making the ecosystem a better place. So thanks to all of you once again, and thanks
Thank
for
you.
having me.
Awesome. Fantastic words. So we wrap up the show. You can all, startups, entrepreneurs who are looking to reach out, you can always reach out to the investors via LATOKEN VC TV. And you can always reach out to other speakers via LATOKEN VC TV. Thank you so much for your time today. I'll be back tomorrow with another topic, another set of speakers. Till then, take care, stay safe, and have a good day. Bye-bye. Bye.
Bye. Thank you.